Hey traders, Jason from Leavitt Brothers. I am long overdue for a state of the market video. The market dipped in September, but has recovered nicely this month. So let's check out the market. Let's see what's going on. Let's look at the indexes, see how they're doing. Let's look at some key breadth indicators, see how they're going. Gains supported, not supported, warnings out there. Let's check it out. All right, so here is the Nasdaq Monthly. Okay, I don't normally show monthly charts, but I'm showing it here. The definition of an uptrend is does the chart move from the bottom left to the top right? Obviously, this this index qualifies. You get support here from the 50-month MA, again here, not really here, there. You could argue that there's this huge gap between the index and the 50-month MA, and that maybe it's like run too far. Okay, it's a legit argument. But otherwise, hey, this is a strong market trending up. There have been some disruptions here in 15, 16, another one in 18 earlier this year. But overall, the trend is up. The market is strong. We're in the top right corner of the chart. Currently, we have an inside month. That's where all the data points from this month fit inside the range of the previous month. Other than just saying, hey, we're a little bit stretched here, okay, but everyone knows that overbought can stay overbought for a long time. Other than saying that, you can't be anything other than just super bullish, super encouraged, and really optimistic about the future, okay? Absent, and we're going to go into some other stuff here in a minute, but for anyone who's bearish, it just doesn't make any sense to me. Okay, the trend is up, the market is strong, it's healthy, and you shouldn't be anything other than having a long bias. Now let's look at the weekly chart. So what you have here, this is a weekly going back. What is it? 1, 2, 3, 4 years. Okay, the 50 is often support here, resistance, support in here. Okay, and when that gives, then you get support from the 200, which was here in here. So we have the index dropping to a lower to a low level here, but then just going straight up. And right now we have this is all-time high territory. We have consolidation pattern at the all-time highs. Index kind of rolling up and down. This is super strong development for the market to rally, for the Nasdaq to rally from 7,000 up to 12,000 and then spend a couple months just consolidating in a range. That's perfectly fine. In fact, if this thing continued to do this for a couple more months, that'd be fine too. Okay, a lot of people zoom in too close. They look at the day-to-day. They're like, the market was down too much today. Oh, did you see that? The market gapped up and sold off and closed at its lows. Back up, 4-year weekly chart, super strong. All we are is in a consolidation pattern within a big uptrend. Price is up in the top right corner of the chart. Could there be dips along the way? Absolutely. But for now, the market is strong and healthy and trending up, and you'd be better off just having a bullish bias, okay? Not many traders can flip back and forth between bullish and bearish. Most traders would be better off just being bullish, and then it's just a question of how much exposure. If the market's going up, then you should be all in. If the market if there are some warning signs out there, then you could pull back a little bit, reduce exposure. But what happens is if you go short when the market just drops a little bit, then you end up missing the next leg up. And the amount of money you miss on that next leg up is a heck of a lot greater than whatever small amount of money you made on the way down. Okay, so market is strong, it's healthy, it's moving up. It's just simply right now it's in a consolidation range, and your bias should be to the upside. All right, here is the daily chart. It shows a better shot of the consolidation pattern that we're currently in. So I want to show you a development that might be forming with the indicators here. So, all right, so market moves up, it's consolidating. What you have here is the stochastic is a shorter term indicator, whereas the MACD is a longer term indicator. Okay, high prints from the MACD, above zero here, that's indicative of, or I should say characteristic of, an uptrend. And within that uptrend, you often get oscillations from the stochastic, which act as like a timing mechanism. So what I see developing here is Nasdaq goes up to close to its high, starts to pull back. Okay, the 50 here in the middle of the range could be support. So a great development, and I'm not making a prediction here, I'm just like, I consider possibilities. With the stochastic breaking down late last week, if the stochastic can cycle down and then reassert at its 50, or cycle down to oversold territory and then reassert from its 20 or below, if that takes place at the same time that the MACD comes down, kisses its signal line is the red line, kisses its signal line and then bounces, and if that coincides with the Nasdaq itself coming down and bouncing off its 50, or even if it bounced in the lower half of the range, that'd be super bearish or super bullish. Okay, this is what I look for with individual stocks, that as long as you get a trend from the MACD, and then the stochastic operates as a timing mechanism within the trend. So if this thing can come down and kiss right here and then bounce off, at the same time the stochastic can cycle down and then reassert itself, that'd be a super bullish development. Okay, so I don't know if it's going to happen. It could happen, but overall, as long as the Nasdaq stays within this range here, the trend is going to be up, and we should have a bullish bias. And if we get this sequence that plays out over the next couple of weeks, that'd be even more bullish. And what are the odds? I don't know. I mean, with the election, with earnings coming up, there certainly is the possibility of having a little bit of weakness here, even if it's not justified. It's just traders are like taking a wait and see approach. Okay, so things look good here. Uptrend, consolidation pattern for the last 3 months. Absolutely nothing wrong with the consolidation pattern after such a big move off the lows. All right, now let's look at some breadth indicators. So here is SP 500. In the middle here, you have the 10-day moving average of the advanced decline line. Okay, you want steady prints that oscillate above 0 to support an uptrend. Divergences tend to warn of declining participation, so you get pullback. So here you got market up, 10-day down, so then you get a dip, and market up, 10-day down, you get a little bit of a dip here. It happens. Market up here, and then the 10-day over here declined below 0, so then we got this dip. So right now, what we have here is we have a super high print, a print that you have to go all the way back to June in order to find another print that high. So this kind of a high print, it builds momentum. So even if you have a pullback in the near term here, the fact that you were able to reset the chart with a high print builds momentum and carries forward. Okay, so high print here, we did get a pullback, but the high print acts as achieving some sort of escape velocity, where even if you get a pullback, the market continues on. So this high print kind of resets the chart and means we have momentum going forward, and even if we get weakness in the near term, the market's probably going to continue up. Okay, because most of the time tops don't form until you get a divergence like this. So when you get a high print, that means in order to get a divergence, it's going to take a couple months of this, and the market's going to have to do this in order to get a divergence, and that's going to take several weeks, a month, or even longer, or it might not happen. Okay, so a high print resets the chart, and it means coast is clear going forward for a while, even if you get a near-term pullback. All right, so here's the cumulative AD line. Okay, not the moving average of it. Just add them all up day after day. Within uptrends, you get steady prints. Here's above the 50-day moving average. So since the March bottom, obviously this thing has been steadily moving up. It got above its 50 here, paused right there, continued up, paused right there, and continued up and paused right there, bigger pause. And just last week, we got a new high print. Okay, so everything looks good. NYSE 80 line, new high, moving from bottom left to top right. Everything looks good here. Market is fully supported. All right, here's new highs. This is new highs at the NYSE, new highs at the Nasdaq. So recently we got a very high print that you have to go all the way back to February to find a matching print. New highs at the Nasdaq, nearly matched, high here, which again, you have to go all the way back to February to find a print. So no, it's not just a couple big cap stocks that are pulling the market higher. You have broad enough participation that new highs at both the Nasdaq and the NYSE recently hit among their highest levels in the last 6 months. It's a good sign. Okay, drilling down a little bit, here are new highs. These are large cap new highs, mid cap new highs, and small cap new highs. So I want to show you the difference between the beginning of a downtrend and what would be just a dip within an uptrend. All right, so if I go back to March, market dropped here, and then it had a 300-point drop, a 300-point rally here. New highs completely fell off, and then they did not expand on the bounce. Okay, if I come over here to June, you have a drop, which was coincided with new highs just completely disappearing. But then look, the market kind of traded flat, and new highs already started to expand. Okay, so the difference here is that market dropped. I'm going to erase these. So, the market dropped here, new highs completely fell off and then did not recover, whereas the market dropped here, new highs fell off but then did recover. So it's the difference between like the beginning of a downtrend and just a dip within an uptrend. So what we have here, we have market dropped, new highs completely fell off, but then they immediately expanded. Okay, so this situation looks a heck of a lot more like this situation and not like this situation. So that tells us that this is a dip within an uptrend like this, not like this. Okay, so another piece of evidence that the market's in good shape. All right, here we have 1 month, the 1 month high low at the Nasdaq, at the Russell 1000. Okay, so the 1 month high low is not a high bar to climb because we're in mid October here, and this is the S&P 500. That high is in early September. So that was like 6 weeks ago. So the bar to climb to get to have 1 month new highs minus new lows is not too hard. Okay, you're basically comparing data points from today to a month ago is somewhere around here. Okay, so not too hard to climb, but it's notable that we have every single data point this month has been above zero, which is exactly what you want to see. Okay, you want steady prints above zero that suggest that tell you that there are more highs, more 1 month highs than 1 month lows. That's what we're getting. So to me, the market is fully supported. We had some low prints here down, during the pullback, but then we immediately got above zero, and we've been able to hold there. And holding there is characteristic of an uptrend. You could get high prints, that'd be nice. Okay, but as long as we get steady prints here, we are fine. Now, as I said, the bar to climb to do 1 month high lows is not too hard. So let's back up and look at 3 month high lows, which means we need stocks eclipsing their early September highs rather than just prints from over here. So let's look at that next. So here is the Russell 1000 3 month high lows, and we have a similar situation. Every single data point this month is above zero, and that's exactly what you want. In order to support an uptrend, you're going to get steady prints above zero. And when you get prints below zero, that's a warning. So when you get, let's see here, let me draw this here. So when you get like the S&P dropped here, but you still had steady prints above zero, that was a very minor dip within an uptrend. You had the S&P dropped here, but then we started getting prints below zero, and that led to further selling. So you can tell the difference between a relatively minor drop here, where the print stayed above zero, versus a relatively minor drop here where prints went below zero and then the market continued down. So right now we have prints above zero, market's doing good, data points are doing good. If we get a pullback here but the prints come in over here, market will be fine. If the prints start coming in over here, then we're going to get a bigger move down. Okay, something to watch out for. But for now, things are good. All right, 2 more charts here. Here's the Russell 1000 stocks above their 20-day moving average. Okay, 20-day is not it's pretty easy to fall below the 20-day moving average. Okay, if the stock just simply trades flat for a couple of days and then drops, it's going to probably be below its 20. So it's pretty common to get low prints, but as long as you get recovery up to above 80%, that tells you we have a recovery and the trend is going to reassert itself. Move to 20%, but then we have a quick recovery. Move below 20% currently, but then we get recovery. So I'm treating the current, the most recent pullback as a pullback within an uptrend because we got really good recovery from this indicator. If we just really quickly compare it to last February, where we got this drop here, which is relatively minor, we got prints down here in 40, and then when it recovered, even though the market recovered to an all-time high, the number of stocks above the 20 is actually, it got up to like 70% at most, but we didn't get any prints over here. So I told you that that participation was waning, and even though we got a bounce here, I should say a bounce here in the market, the number of stocks that got above their 20-day moving average was much less than the previous move. So there was a little bit of a warning here. But this is in great shape currently. The 5-day moving average of this hit its highest level since June. Okay, so this builds momentum, and even if we get like a little bit of a pullback, the momentum built from this should enable the market to dip and then recover. All right, one more chart. Here's the Russell 1000 stocks above their 50-day moving average. Okay, so a little bit higher bar to climb, but the analysis is pretty much the same. You get steady prints in the 50 to 80% range. Confirms like a steady uptrend. We got a low print here, recovery. Right now we are in that 60 to 80% range. Market's in good shape. If we compare it to last February, minor dip over here, brought the indicator down to 45% or so. On the recovery, you had not a very good recovery. Okay, stocks above their 50 only climbed up into the 60% range. So you get prints. You get prints over here in 80%, 80%, 80%, 80%. That's a sign. That's a good sign. Okay, that's a sign of strength. It's a sign of good participation, and we got pretty close to that on the most recent high. So the market's in good shape. It's pretty well supported. 5-day matching high levels from here, all the way back. So overall, good shape. All right. So overall, the market looks good here. The indexes are simply in consolidation periods within uptrends. Breadth is supportive, and I didn't talk about this here, but most leadership stocks are doing well. Absent a major news item, the path of least resistance is up. In fact, since the market is strong enough to absorb some bad news and some selling pressure, I'm actually rooting for it. I'm hoping that we get another dip that sets the table for us to buy some quality stocks at lower prices. Thanks for listening. Come check us out at Lever Brothers, where we offer market analysis and trading ideas to the financial community. Also, check out my free masterclass in trading at the link below. All right, thanks for listening, and I'll see you next time.